Let's dive into the creation of CLOs, which stand for Collateralized Loan Obligations, and compare them with CDOs, Collateralized Debt Obligations. They might seem similar at first glance, but there are distinct differences between the two. Now let's explore the CLO creation process in detail. How exactly is a CLO created? The first step is identifying the asset pool. In the case of CLOs, these assets are typically loans. Specifically, banks gather a diverse pool of loans, often leveraged loans made to corporate borrowers. For example, a bank might select a portfolio consisting of 500 million worth of loans to various companies across different sectors. The next step is to form a special purpose vehicle, or SPV. Creating an SPV helps isolate the assets and facilitate the issuance of securities. This ensures that the assets don't appear on the balance sheet of the originating lender. For instance, you could establish an SPV named CLO Issuer LLC. Next up is structuring the CLO. You'll need to design the CLO structure, which includes tranches of varying risk levels, such as senior, mezzanine, and equity tranches. Equity holders, for example, receive any remaining payouts after bond interest and preference dividends are settled. In this structure, the equity tranches receive payouts in the same manner. For instance, you might split a $500 million loan pool into 300 million senior tranches, 150 million mezzanine tranches, and 50 million equity tranches. This demonstrates how the structure is formed. Next, you'll conduct a credit review of the tranches and then issue securities to interested investors. These investors are typically institutional, such as pension funds and insurance companies, which take on the associated risk. The following step involves managing the CLO. Ongoing management of the portfolio is crucial for optimizing returns while complying with reporting standards. After that, it's time to distribute the cash flows. Cash flows from the loan payments are distributed to bondholders according to the predefined structure. For example, distributions are made first to senior tranche holders, then mezzanine, and finally equity investors. This sums up the CLO process. Turning to CDOs, the process begins similarly by identifying asset pools. For CDO creation, the focus is on selecting a collection of debt instruments such as bonds, mortgage-backed securities, or corporate credits. For example, you might collect 600 million worth of various corporate bonds and mortgage-backed securities. An SPV is formed to manage the CDO, similar to CLOs, and the pool is divided into tranches based on varying credit risk levels. In a sample structure, there might be 400 million senior tranches, 150 million mezzanine tranches, and 50 million equity tranches. This highlights the differentiation. Next, you'll need to obtain a credit rating. You can enlist companies like S&P to review and rate the securities. Then, issue the securities to interested investors. In CDOs, hedge funds, mutual funds, and institutional investors often participate and purchase these transactions. Managing the CDO involves actively handling the assets within it to maximize returns. Regular assessments of the credit quality of the bonds in the portfolio are essential. Lastly, cash flow distribution occurs. The cash flows generated by the underlying assets are distributed to tranche investors according to the investment agreement. As a practical example, for a CLO, consider a bank pooling 500 million in loans and forming an SPV. Issues.